Hello, traders, and welcome to a new episode of Beyond the Charts. Last week was eventful. We had some really important data. We are finally seeing some numbers coming from the US after the longest shutdown ever. The government shutdown, of course, I'm talking. And we had some interest rate decisions from different parts of the world, like New Zealand, for example. We'll get to that in a minute. As always, we're going to go day by day through the economic calendar and see how each data point impacted the market so that we can know what happened last week and make our new decisions or next week's decisions based on actual information and data from the week before. So, without further ado, let's get to it. We start with Monday. On Monday, we had a holiday in Japan, which was the Labor Day, so nothing of major impact there. Um, um, Japanese markets were closed, so no Nikkei or JPY data or trading. It was a quiet Asia Open. Um, so no big global waves came from Japan not being there on Monday. So that's it for Monday. We move now to Tuesday. Tuesday was eventful. We had the German GDP. The previous reading was at minus 0.2%. The forecast was an improvement to 0%. So the GDP is not contracting, it's as is, it's at 0%. And the actual came in actually in line with the forecast, which is at 0%. So, what does that mean for the markets? It means that it came as expected. So, no major movements came after because it came in as expected. Um, the Eurozone engine, which is Germany, is like on a quarterly basis. They're stalling, they're not making any improvement, they're not growing. Exports and services are steady, but investment is still weak in Germany. No recession, but also no acceleration. All right. So how did that impact the markets? This news release actually didn't impact the market much, as I said, because it came in as expected. So the DAX stayed flat. The US Open was neutral. Gold was neutral. Euro USD was steady. So no major impact after this number, although it should have been or it should have brought more volatility or more impact to the markets. But again, because it came in line with expectations, the markets were not surprised, so we didn't see any big movements. We move now to core retail sales from the US. The previous was 0.6%, the forecast was 0.3%, and the actual came in at 0.3% as well. So, what does that mean? Um, it matched the forecast, obviously, but it slowed. It's slowing down. It was 0.6%, now it's 0.3%. So, core spending, which is like excluding autos and gas, held firm on essentials. Um, but the dip from prior numbers signals moderation amid holidays. Maybe that's the reason. We saw it go down from 0.6% to 0.3%. Maybe that's because of holidays. And then we move to the PPI, also came from the US. So the previous reading was minus 0.1%. The forecast was 0.3%. And the actual is 0.3%, came in line with expectations as well. Now, the PPI is a leading indicator. It's the producer's price index. It shows or it paves the way for the CPI because, as I explained it before in previous episodes, uh, the inflation or the prices of the raw materials first affect the producers, and then the producers pass this extra cost on to consumers, and then we have inflation. So this is a very important inflation gauge, which came in higher than the previous, but in line with expectations. So what did it mean for the markets? Um, they're up on energy. Producer prices are up on energy, but the core is 0.2%. which is tamed. Inflation is steady. It's not spiking, but it's higher than the previous. Um, so how did that impact the market? We saw the S&P gaining 0.2% after this release. Gold lost 0.1%, and the USD remained flat. Now we move to US retail sales. Okay. Um, we saw the previous at 0.6%. The forecast was a drop to 0.4%. The actual came in worse than both. It came in lower than both at 0.2%. So it's a miss, um, meaning that the headline sales slowed more than expected. Autos and gas dragged. So how did that impact the market? Retail stocks lost 0.3%, the Dow remained flat. Gold gained 0.2% on slowdown, and USD lost 0.2%, while Euro USD gained 0.2%. Now we move to US CB consumer confidence. Now the previous was 95.5, the forecast was a drop to 93.5, and the actual came in worse or lower than both at 88.7. So that's a big miss. Confidence is plunging on jobs and inflation fears. Um, like, is it a recession signal? We don't know yet, but the confidence is dropping in the US economy. How did that reading impact the market? The Nasdaq lost 0.4% on sentiment hit. The gold gained 0.4% as a safe haven, and the USD lost 0.3%. All right, so that's it for Tuesday. Let's move to Wednesday now. Okay, on Wednesday, we had the interest rate decision coming from New Zealand. So the Reserve Bank of New Zealand cut rates by 25 basis points. As priced, of course, it was expected. Inflation is in the like in New Zealand is at 2.2%. So it's very close to the target, and they will ease more if they need because they're almost at their target of 2%. How did that impact the market? The NZD USD lost 0.4%. The USD gained 0.1%. Gold gained 0.3% after this release. The NZX, which is the New Zealand index, gained 0.4%, while the S&P gained 0.2% after this release. Now, next we had on Wednesday, we had the UK autumn forecast statement. So what happened there? Reeves outlined the budget. So the growth is 1.2% in 2025, down from 1.5%. There's a deficit of 4.3% in GDP. So they made some tax hikes and spending cuts so that they, as part of a fiscal repair, so to speak. Okay, so they're trying to fix the economy. That's why they hiked taxes, and they made some spending cuts so that they will have more room to fix. So what does that mean? It means slower growth, and Bank of England might be cutting rates soon to boost this growth, okay? Or to compensate for the slower growth coming from this statement. Now, how did that impact the market? The gold gained 0.2%, the FTSE 100 lost 0.2%, of course, and the GBP USD lost 0.2% as well. Next, we had the durable goods orders coming from the US, the monthly number. The previous was 3%. The forecast was a huge drop to 0.5%, and the actual came at 0.5% as expected. So, what did that mean? It matched expectations, but it cooled. Orders are steady on transport. Core X Air 0.2%. Business investment is okay. That's pretty much it. How did that impact the market? Industrials gained 0.3%. The Dow gained 0.2%. Gold remained flat, and USD gained 0.1%. All right. Next, we had US initial jobless claims. So previous reading was at 222,000 jobless claims. The forecast was an increase but the actual came better. It came with lower or fewer jobless claims from the US. So less people are claiming to be jobless, which is positive for the labor's market. All right. What did that do to the market? Labor market is actually showing some resilience. Stocks and indices, the S&P 500 gained 0.3% after this release. Gold lost 0.1%, and USD gained 0.2%. All right. Next, we had the Chicago PMI for November. So the previous was at 43.8, which is way below 50. So it's in the contraction territory. The forecast is an improvement to 44.3, still bad, but it's an improvement. But the actual came lower than both. It came at 36.3, which is very bad. So it's a sharp miss. Contraction is deepening, and orders and employment are down. So it's a regional weakness overall, okay? Now, how did that impact the markets? The Dow lost 0.3%, gold gained 0.3%, the USD lost 0.2%. And finally, on Wednesday, we had crude oil inventories. So the previous reading was minus 3.426 million barrels. The forecast was like minus 1.3 million, but the actual came in higher. So it came in as a surplus of 2.774, meaning that demand is not keeping up with supply. Supply is outpacing demand. That's why this is a bad signal or a bearish sign for the oil price. And we saw the oil actually dropping after this release. It wasn't a very good year for oil overall. How did that impact the market? The energy stocks lost 0.5%, the S&P lost 0.2%, gold gained 0.2%, and the USD lost 0.1% after that release. But by the way, I don't think the USD has anything to do with this release, but because it happened right after the release, that's why I'm mentioning it. All right, now we move to Thursday. We had nothing of high impact. We had actually Thanksgiving Day in the US. So there was no trading in the US. Of course, CFDs were moving, but like the official markets and official exchanges in the US were off. Sorry, pardon me. They were off. So it was like a very, let's say, it was a thin liquidity day. There was no, there wasn't much liquidity on Thursday. So it was a quiet global day, so to speak. So gold remained stable. The FX majors had like very thin moves. So nothing major happened there. Then we moved to Friday. On Friday, there was an early close also because of the Thanksgiving holiday in the US, but we also had the German CPI, which is the German inflation. And the previous was 0.3%, the forecast was minus 0.2%, and the actual is minus 0.2% as well. What does that mean? It means that it matched the expectations. Prices fell on energy because energy prices are dropping, and Germany is a manufacturing country or a manufacturing economy. They manufacture a lot of things. They have a lot of factories, so energy prices affect their prices like immediately or directly. So this inflation is going well. So ECB is more likely to cut after this reading in their coming meeting. All right, so how did that impact the market? The DAX gained 0.1%, gold gained 0.1%, and the Euro USD gained 0.2% as well. Now, that's it for last week. That was everything. The big picture is that US consumer is softening. Retail sales like missed expectations. The confidence is low, but claims and durables are okay. The Royal Bank of New Zealand cut rates, and the UK budget showed some intention for fiscal repair. Okay, and Chicago, we saw a regional a weakness in the Chicago PMI number. It was very weak, easing the bias, sorry, or growing the easing bias. Okay, so that's it for this episode. I hope this was helpful. Um, as always, use stop losses, trade responsibly, and I'll see you on the next one, guys. Take care of yourselves, and if you have any questions, please drop them in the comment section below. Take care, and I'll see you in the next one. Bye bye.